Hello, everyone. Welcome to our special session on understanding bank failures. My name is Pavlina Cherneva, and I direct the OSUN Economic Democracy Initiative at Bard College, which has partnered with the Economics Club at the University of Missouri, Kansas City, to bring to you this event. Let me start with a well-known quote by John Maynard Keynes, who in the 30s quipped that markets can stay irrational longer than you can stay solvent. So we've just gone through a long week of bank liquidity problems and another round of extraordinary Federal Reserve interventions, which have left many wondering, is this over? Can these liquidity jitters create more systemic problems? So we are really delighted to welcome one of the world's foremost bank experts and white-collar criminologist, Professor of Law and Economics, Bill Black, to this forum. My very special thanks to EDI research scholar, Matthew Robinson, who organized this event, and for Bill for making the time. Though Bill hardly needs an introduction, I want to give the floor to Robinson to introduce him and then to moderate the discussion. So off to you, Robinson.
Hello all. Thank you for joining us today. This will be recorded, and so, if your questions don't get answered, feel free to revisit. And thank you very much for joining us. Just some announcements. UMKC is probably going to have an LPE chapter. This is for folks who are interested in cross-sections between law and political economy, which makes a perfect fit for what we've been doing at UMKC for more than 20 years, including some of Dr. Black's work that you're about to hear. And on March 29th, we're going to have Lucas Lerner discussing a jobs guarantee program that they have in Mirenthal. So that should be exciting. Please follow the sign up for Twitter, follow those Twitter accounts for updates. And so I'm going to introduce Dr. Black. Again, like Professor Cherneva said, he doesn't really need a big introduction. Almost 20 years ago, he wrote this book, The Best Way to Rob a Bank is to Own One. I've been revisiting this book this week, and unfortunately, regulators at the helm have not. And so I wanted to make sure that we got the input from a regulator on this. There are going to be lots of great think pieces and explainers that you'll find on the internet, lots of not so great ones. And so Dr. Black is here to clear everything up for us. So again, thank you for joining us. As you have questions, please type in chat. I will keep track of those, and we'll be off to it. Floor is yours, Dr. Black.
All right. So thank you to both of you for those setting this up, and for we know how much work it is behind the scene, and without these kinds of efforts, all of us would be much poorer. In addition to what you've heard, I was a banker. Indeed, I was general counsel of a pretty large bank, the Federal Home Loan Bank of San Francisco, and that bank actually plays a significant role in some of these events, both at Silicon Valley Bank, which I'll probably call SVB, and at Republic right now. In fact, it's being called the next to last lender of last resort, with the Fed being the last resort. So for example, it lent $20 billion to Silicon Valley Bank. And Silicon Valley Bank became its largest single customer. And back in my day, not a penny of that loan would have ever been made. And I sat on the credit committee and I would make sure that I was one of the votes to keep that loan from being made. So it's the older you get, the more of these weird things happen to swing into fashion. My share screen has disappeared. Anyone? No quick way of pulling that back up?
One second.
If not, there will be slides available that you can get that will add, and I can do it live type of thing. So I'll start out with live. This is all about interest rate risk and how interest rate risk leads to, or can lead to, liquidity risk, and how liquidity risk can kill you right quick. So it's the opposite, really, of the famous line about economics that Dr. Cherneva started us with. Markets finally got somewhat less irrational, and that was very, very bad news for SVB. Okay, I will.
We'll try to share now. I think you're co-host now.
All right, do you see them?
I do not. Robinson, can you step in and see?
Okay,
Yeah,
so that's not good.
I do not either.
And I still don't see anything on my screen. When I began, there was share screen, but that no longer is one of my options.
Yeah.
Again, I can do this live. There's a deck of about 40 slides that we can provide to everyone through the club. All right. So what the heck is interest rate risk, and what the heck is liquidity risk, and why are the two related, and why does one of them kill you right quick? If you move your cursor to the bottom of the window, the share option should appear. Okay. Maybe more. Maybe if I hit more. Aha. Share screen. No. Actually, the one. Okay. No. Too many. I got it. Okay.
And if it's easier for you to email them to me, I'm happy to display them.
Here we go.
You got it? Okay.
All
Excellent.
right. All right. Here we go. Go away, thing that's in the middle of my screen. All right. Of all the things that conventional economists are proud about, and they are proud about many things, the financial revolution is number one. It represents the intersection, in their view, at the respective maxima of sophisticated quantitative mechanism designed, their justified faith in markets, and all their best quant stuff as well. So this is where they say they should be at their absolute best. And of course, they tend to be at their absolute worst. As Volcker always emphasized, elite bank CEOs and boards of directors have no ability to understand the quants. The Fed dominates policy, and economists rule the Fed. Central bank independence, of course, is all the rage internationally because of all this. And the revolving door ensures an incestuous government-industry relationship so that the policy in these areas is made by economists, overwhelmingly and more precisely those who specialize in financial economics. There was some weird stuff that I won't go into now about the disingenuous nature of the most recent Nobel Prizes in economics, which actually said nice things about deposit insurance. But in fact, the FDIC is the great Satan to conventional financial economists because it purportedly unhinges private market discipline, which is the thing that is supposed to lead to ultra efficient markets. And because it allegedly unhinges this discipline, all the problems in banking observe are caused, and they are symptoms of gambling for resurrection, which is also known as moral hazard or sometimes a financial option. And economists who specialize in finance, it's really difficult to convey how much they hate federal deposit insurance. And the thing that drives them absolutely bonkers is that national deposit insurance has surged globally over the last 3 decades, despite their efforts. We, of course, developed our financial system since the Great Depression, heavily based around the FDIC. And as I've said, that's exactly what has led much of the world to follow our pattern. And this has meant that financial economists from conventional schools have spent a great deal of their time saying, okay, how can we get around this terrible thing of FDIC insurance and reestablish some kind of private market discipline? So, of course, depositors aren't going to create that private market discipline if they're insured, because it's expensive to do private market discipline. It means you're supposed to know whether the bank is healthy or not, and banks are incredibly complex and opaque. So it's not just a hard job and a sophisticated job, it's a really expensive job. And if you're fully protected by deposit insurance, the argument, which is sensible, is depositors aren't going to spend much of the time doing any such thing, of exercising discipline. And so financial economists have said, how can we find other sources of discipline? And what they've come up with overwhelmingly is, well, we could use shareholders, right? There's an alternative, subordinated debt. You can look at the slide in terms of that, but that hasn't worked either. So 2 big theories or 2 big policy applications on how to use shareholders. One is the Basel process. This is the international process. Nominally, it's just for the biggest economies in the world, but as a practical matter, it's overwhelmingly the global banking system at this point. And Basel is premised on enforcing minimum risk-based capital requirements that are supposedly sufficient to counter moral hazard. And then in the United States, again, very conservative economists developed this concept of prompt corrective action and actually got it enacted very much as they asked for it. And I have to tell you, that's a miracle. In late 1991, in a way that's supposed to optimize shareholder discipline, and other nations are adopting prompt corrective action, and it's actually embedded into the Basel core literature as well. So the idea on prompt corrective action, and that's obviously what we didn't get in these crises, is, well, prior to the insolvency, at which point shareholders' interests become perverse, prompt corrective action mandates that the regulators close the bank and removes the regulators' capacity to forbear on such closures except in really extraordinary circumstances. And the economists who framed prompt corrective action promised it would easily, that was their word that they actually used, eliminate nearly all bank failures and minimize FDIC resolution costs in the rare failures that continued, and it would minimize it so much that bank failures would no longer be a problem and we could have dramatic deregulation. And that's what, as very conservative economists, they really, really wanted, maximum deregulation of banks. Okay. And, just one big problem with all of this is supposed to ensure adequate capital. And places like SVB, of course, were subject to these and were supposed to require substantial capital. In fact, SVB had a market capitalization of about 15 billion shortly before it collapsed as an insolvent disaster. So the anti-regulatory economists, heavily associated with the Fed, which takes the lead on Basel process, deliberately decided to invite the biggest banks and only the biggest banks inside the tent to formulate what they were working on to become Basel II. And this is in the run-up to the great financial crisis. And they also conned the economists into allowing the banks to set their own capital requirement using their own proprietary risk models. And I know it will shock you, but their own proprietary risk models showed that they had virtually no risk and therefore needed no capital. In fact, the Fed economists were pushing this even though the biggest banks would have capital requirements so low that under the law, remember the law, the prompt corrective action, those same institutions would have been called critically undercapitalized under the prompt corrective action, but under Basel II, they would supposedly be the epitome of purely ample capital and such. So you can imagine that didn't work out so well. And the prompt corrective action capital triggers were based on the bank's reported capital, not their actual capital. And we're going to see that's a big thing at SVB as well. And bad bankers can and do massively inflate reported capital. It's actually quite easy to do. And the bottom line of all of this is that our financial system, whole regulatory framework, is premised on banks having ample capital. But we actually have two pillars to this system, Basel capital requirement and prompt corrective action in the US context. And neither one of them actually requires even remotely ample capital. In fact, it's quite possible to be deeply insolvent, a la SVB, and reporting that you have tons of capital. So prompt corrective action doubled the average FDIC resolution cost after it's adopted, right? And despite that, it's still endorsed by Basel and spreading internationally. And Basel II was a catastrophe in Europe. If you wondered why was the European great financial crisis actually much more severe than the United States, given that a whole bunch of the loans that seemed to prompt the whole thing were in the United States, it was in large part the fact that Europe in particular adopted Basel II with huge banks can have virtually no capital stuff, while it didn't happen in the United States. And it didn't because the FDIC actually fought a heroic rearguard action against Greenspan and his minions. And if that hadn't been true, the great financial crisis would have been much more severe in the United States. So when we look at the scorecard for financial economists, Basel II, well, that failed. Prompt corrective action, that failed. Efficient markets, well, the great financial crisis disproved that. Capital asset pricing model, well, even the Nobel Committee, after giving a Nobel for CAPM, admitted in buried text years later, actually it doesn't work, it's completely wrong. Microfinance got even the Nobel Peace Prize, but it's been a disaster. Private deposit insurance, which was supposed to have the right incentives because it was for profit, that was a catastrophe. Subordinated debt as a means of preventing problems has proved to never work. And good old long-term capital management had dual Nobel laureates, and not just any Nobel laureates for modern finance, and that failed catastrophically as well. So really, this area where they say they're at their absolute best is an area in which they've had one catastrophic failure after another. And indeed, I call these dead wrong. Dead wrong is when you're not simply don't provide the benefits you promised, but you actually screw up the world enormously. And so why? Well, largely arrogance, right? Economists are convinced that they have this magic thing, mechanism design in the toolkit of every economist. They mean conventional economists, by the way. That's their phrase, that all conventional economists have a toolkit and it's universally applicable and it allows you to solve any incentive problems. Well, bank CEOs turn out to be a whole lot better as strategists than economists, academic conservative economists. And whatever system the economists come up with, the bankers just scam the system, and they make a ton of money. So this is, in academic terms, we're studying strategic behavior, right? And as I say, the foundational problem is conventional economists are just incredibly arrogant about these things. So let's start out. Incentives. Yes, incentives really matter, but banks are not sentient. They have no incentives. They have no ability to protect themselves and from predatory CEOs. And so all kinds of ways, over a dozen times, conventional economics silently assumes these pathologies out of existence. And they do so, for example, by saying the firm maximizes profits. Right? Firms, of course, aren't sentient. They can't maximize profit. And they've silently assumed out of existence what not one, but two Nobel laureates, Akerlof and Romer, way the heck back. In 1993, Looting, the economic underworld of bankruptcy for profit, pointed out, no, they don't necessarily maximize profits, that CEOs can find it much more profitable to loot the firm by creating fictional profits in all of these things. Okay, this is not, by the way, going to be a talk about fraud. This is going to be a talk about interest rate risk, but strategic behavior remains the critical thing. All right. When financial markets are even relatively kind of efficient, risk and return should be positively related in credit risk capacity. And operational risk should be negatively related to expected returns. Why? Because operational risk is things like people stealing, it doesn't have an upside for the firm in all of this, right? Unless, of course, you're stealing from others. So we're talking about where the firm is being the victim in these cases. Credit risk. So why credit risk different? Why does it have a positive expected value if you do it right? Because you can combine expertise, experience, and feedback/learning systems to create superb and ever improving underwriting. And that reduces the foundational asymmetry of information in lending, and that lets you lend profitably and better than other folks. Okay, so you can't simply say risk is positively related to expected return, because it depends on the kind of risk. And liquidity risk is another one of these things. Now, it's actually sort of the most complex to do, but it's not super complex. Here it is. Sure, we don't want to be absolutely awash in liquidity, right? As a bank, unless we're lending the money out, we're not making any money on it. So there's always a balance, right? But it's an asymmetrical problem. Expected value, of course, is simply a weighted probability. So what if the weighted probability said, yeah, this is a profitable course of action, but when you decompose it, oh, by the way, there was a 20% risk the bank would fail, in a liquidity crisis. That's not a good bet, right? So that one's a little more sophisticated. You can't simply go off expected value. You've got to look at the nature of what you're betting. And so liquidity risk as a metaphor is a bit like pneumonia. Often it's a different underlying pathology that puts you in the hospital, but the thing that kills you quickest is pneumonia. In this context, interest rate risk was the foundational problem, maybe beyond that, maybe some operational risk, but it seems to be mostly interest rate risk. But the thing that kills all of these banks first is liquidity, right? And so you don't F with liquidity, right? As a banker. And again, I have been a banker. You are careful about these things. This is what Warren Buffett means when he says, I like to sleep at night, right? You don't chase yield in tiny amounts by minimizing your liquidity if you want to be able to sleep at night, if you want your bank to be able to survive and such. You have a healthy cushion and you maintain it. Okay, so for most financial risks, the expected value is 0. And this is true of interest rate risk, basis risk, prepayment risk, currency risk, for example. These are all major risks that firms occasionally do. But their expected value out of that, unless they can find a way to game you as the counterparty, is going to be 0. And if it wasn't, if there was a positive expected value to interest rate risk, for example, then we would all be incredibly wealthy. We'd hire that person that figured out how to know what interest rates would be, and we make him or her really rich, but they would make us all fabulously rich. It doesn't happen. It ain't going to happen. So interest rate risk is not something that a bank should be doing as a profit center, right? So when do banks and bankers add value? When they engage competently in activities with positive expected value. They should maintain ample capital and liquidity. They should be fierce in minimizing operational risk, and that would include things like sleazy CEOs. And another operational risk at SVB, for 8 months in 2002, the last 8 months of 2002, they had no chief risk officer. That's a hell of an operational risk. They had a committee that dealt with supposedly operational risk with 9 members, of which 1 had any experience with risk management. And that was not in a senior position. So, you know, think of being on a submarine and having no sonar operator. And the people who were supposedly supervising the sonar operator had no ability with sonar. Lots of luck. Don't run into the seamounts too quickly, right? Very bad. So these insights should lead to a pretty strong role for regulation in the specific things I talked about. In other words, as regulators, we want you to make sure that you're taking prudent credit risk and you're not only good at it, but you're getting continuously better at it through feedback and all those type of things. You learn from experience, right? You develop better systems over time. Conversely, if you're taking operational risk and for you, that's just fine. No, no, not having a chief risk officer when you're the 14th largest bank in America. Not okay. Not okay for a day. Not okay for a week. For 8 friggin' months while you're doing this stuff. Absolutely insane. Fraud. Insider fraud, we want to be absolute death on. But what if you're just a bank, but you have federal deposit insurance and you say, what I'd like to really do is take massive amounts of interest rate risk, which has an expected value of 0. And again, it's asymmetrical because I'm the frigging insurer and I'm, you know, protecting the taxpayers of America, right? I should have a strong bias against failure in those circumstances, right? I shouldn't say, oh, fine. By the way, we'll take all the losses. If your interest rate goes really, really bad, after you lose your equity, which is next to nothing, we will take billions, hundreds of billions, trillions of dollars in losses. No, that would make no sense. In other words, again, these fundamental premises of how risk differ should explain how we regulate. And lots of things are exceptionally difficult in finance. Dr. Jorian, one of the quants experts, has said his adjective for how difficult it is to do the quant work on assets that have very substantial prepayment, which is to say American home loan mortgages. He calls that difficulty hellish, right? So we really, really, really want to be super careful if you're taking on things that have hellish degrees of difficulty, and we have to be asking, why the hell are you doing it in a context where you're taking on hellish degrees of difficulty? Okay, I'm not going to make this talk on crypto, but crypto is difficult to understand, mostly because it's surrounded by all this BS that's quite deliberate and designed to obscure the underlying con. And Barney Frank is an idiot. You know, his self-interested whining about a conspiracy to destroy crypto driving these bank failure closures is just pure nonsense. But then again, the folks who say that it's because of wokeness. I love it. Really, really fun stuff. Okay. As to interest rate risk, in the context of places like SVB, that simply isn't one of the real difficult things in life. You don't need to be able to do the exact analytics to know exactly what the numbers are. Despite what I said, if you took 8 people who simply understood banking and interest rate risk, even if you had no chief risk officer, they should have gone, what the? You know, and completely changed the operations. Obviously, none of them did anything like that. So what you do need to know, again, is that interest rate risk is a really good way of kicking off a run, and that there have been lots of these runs historically. and they're not weird. They're not illogic necessarily, right? They can be perfectly logical. If I get to the bank first, while they still have cash, I get 100 cents on the dollar. Whereas if I don't, well, then I got to need a bailout for all depositors. Now, we know at SVB, they eventually had enough political power to get that bailout, but that's not a terribly good answer, right? We have insurance limits, but they don't really matter if you're rich and powerful. So not a particularly good policy bailing out those uninsured depositors who, after all, got a premium interest rate because they were beyond the insurance limit. And now they get their premium rate and they get bailed out. So the fact that the same banks were simultaneously taking severe interest rate risk and emphasizing uninsured depositors was obvious to bankers. All the competitors knew, and it was obvious to the regulators as well. And why is that really important? Well, who's going to stage a run? Not in modern America, the people who are fully insured. But SVB had most of its deposits in folks who we call corporate treasurers. And corporate treasurers can and do literally remove $500 million in deposits through what is literally about 3 keystrokes, which is to say they do it right quick, which is to say the largest run back when I was a regulator was right around $6 billion. In the great financial crisis, the run on money market mutual funds, and that run was overwhelmingly by corporate treasurers, was $400 billion. And the run at SVB was over $40 billion in a day. So when you deliberately attract immense deposits that are uninsured, you are maximizing the risk of a run. And when you take immense interest rate risk and lose such that you are market value insolvent, that's not irrational to run. That's a perfectly sensible thing to do, right? And it was simply a question of time as to how long it was going to take. Now, by the way, it took a long time, which is another reason why this whole thing about market discipline. Remember, conventional economists think it's great having uninsured depositors because they're going to be sophisticated and emphasize market discipline. No, they waited a year. This place had been insolvent for at least a year. And then they sort of went, oh shit. So yeah, I guess it's better than no discipline, better than the regulators, because there's no sign that the regulators were about to close these places or even take effective action against them. In any event, so SVBs of the world do not one bad thing, but a whole series of bad things at the same time, and these interact. And that's why they go glug, glug, glugs so quickly. All right, so again, you got to focus. What is the potential gain of taking severe interest rate risk in these circumstances? Well, would it help to know that the failures to date, the instruments in which they were taking interest rate risk, at least reportedly, were, based on press reports now, had yields of about 1.8%. That was the upside. Woo, if it all works, I get 1.8%. And if it's a downside, I get a run and the bank's destroyed. Or the government, the FDIC, bails out the depositors who were vastly above the insurance limit. This risk and return are immensely asymmetrical at that level. You can't win big by buying 1.8% paper. Right? Even if rates were to drop considerably, yeah, we go up, but again, the risk and return are just insanely asymmetrical in the wrong way. So there's only one prudent regulatory response, and it should have come years ago, which is no, you can't take interest rate risk of this regard, this degree, period. End of story. If you can persist in trying to do it, we will shut you down. So on top of that, the asymmetry of the risk and return, it was almost certain you were going to lose this bet, because remember, what the hell are you betting on when you buy 1.8% paper? You're betting that rates are going to fall. The freaking Fed is telling you, nope, we're going to raise interest rates, and we're going to raise them, by God, until we crush the economy. We're going to force millions of people into unemployment. They're testifying about this, right? So it is near certainty that you will lose the bet. And remember, when you lose this bet, you lose the bank. So this is crazy. And remember, the Fed is supposed to be a regulator. The Fed knows what the Fed is going to do. The Fed knew it was going to raise rates by 450 basis points collectively, right? A series of rate increases. It wasn't a shock. They weren't surprised as regulators. They were the ones doing it. That's supposed to be the overlap, that's supposed to create the huge advantage and make the Fed a superior regulator. Great theory. Not so much working. Okay. And it's, again, you don't have to know the exact numbers to know that if the Fed raises rates 450 basis points and you're buying 1.8% paper, which is 180 basis points, you're freaking going to lose. And you're freaking going to lose huge in these circumstances, right? So everybody knew this. The most unsophisticated bank regulator in the field knew this. It's not everything in finance is hard. This one is really easy. And, after all, there's a whole literature in conventional economics that says, yes, we expect these folks to gamble, and that the way they'll gamble might do this, right? Okay. So the worst conventional economist in the world should have also known this. And it's not like, sometimes they use camouflage and fig leaves and it's hard to read through. But SVB's nominal hedge was $550 million. On a portfolio of 120 billion. This isn't even a fig leaf, or if it was a fig leaf, everything was still exposed, right? It's just nuts. Absolutely nuts. Okay, so 5 embarrassing concurrent failures on all of this. This is easy to get right. It was critical to get right. It was critical from the bank's perspective. It was critical from the regulator's perspective. The bankers failed, the private market discipline sources all failed, the regulators failed, Congress failed, and at least the last 3 administrations all failed in this regard, and none of them came close. To date, no heroes have emerged. None. There's no whistleblower saying I lost my job because I tried to get the Fed or any other entity to do the right thing. The great financial crisis did not shake either party's central tendency adherence to the dogma that basically you can trust elite bankers. And, you know, the great financial crisis was a catastrophe because of that. Okay, so that's bad. But even after the failures, earnest media and progressive members of Congress have drunk so deep of this anti-regulatory dogma that they say things repeatedly like, oh, SVB's assets are good because they're mortgage-backed securities and they have a governmental guarantee, or they're treasuries and they have a governmental guarantee. Yeah, they're good. They're also worth 30 cents on the dollar. Probably 60 cents. Okay. That's not good. Calling it good exposes that you still don't get it. That you think, oh yeah, you just hold. It's just a paper loss. Number of you have taken my class, and I said, get out your resume and update it if your boss says any of these phrases, because he or she is a moron, and they're going to lead you into a disaster that's going to destroy your reputation as well. I mean, so yes, of course, try to educate them, try them to get to do the right thing, but if they don't, get the hell out of there, right? These are all still don't get it. Now, again, it's not their fault as much as it's the regulators' fault, because the regulators have never educated Congress appropriately about interest rate risk. And that it doesn't matter that the thing will get repaid at maturity, because you won't be around at maturity. You'll be destroyed in a run. Long before that, and the government will be then stuck with the paper. And yes, the government can sit on it for 6 years and declare, hey, see, we resolved it with no losses. But it's not real, right? So, central quiz about strategic behavior. Under GAAP, if the CEO says he intends to hold the asset, the bank recognizes 0 losses on the MBS or treasuries as their market value falls like a rock as the Fed raises rates. If the CEO says he is holding those same assets for sale, the bank has to recognize a loss. So here's the question to you. What do you think bank CEOs did as the Fed raised rates? They transferred massive, and I mean hundreds of billions of dollars in losses, which is to say multiple hundreds of billions in nominal value of these underwater assets. Underwater in this context means that they're not worth their stated value. They transferred, this bank CEOs transferred them from available to sale to intend to hold. Poof. The losses disappear. From reporting, of course, the losses don't disappear at all. To my knowledge, maybe somebody else has heard, but I haven't heard a single regulatory leader order a halt to that practice. And they've known for well over a year that's going on. And actually, of course, we've known for decades that's going on. So again, SVB purported to have a market cap of 15 billion. You know, that efficient market stuff. The irrational part was not the run. The irrational part was believing that SVB had a market cap of 15 billion, right? When it was actually insolvent and worthless. and run by morons in a moronic fashion. So why doesn't Congress know? Well, in part because the government regulators who know don't tell Congress that. And how do I know that? Because one of the absurd responses, well, absurd in reality, nominally looks perfectly sensible, responses to the great financial crisis was to say, oh, this must have been a problem of not listening to the economists. Let's put the economists at the key of regulatory policy. Let's create FSOC, Financial Stability Committee, right? And we'll staff that almost exclusively with economists. And then we'll make a montage of 8 different regulatory agencies and such. You know, it's nightmarish, but hey, okay. Here are the statutory purposes of FSOC. 1, identify risks to the financial stability of the United States that could rise from the material financial distress or failure or ongoing activities of large interconnected bank holding companies or non-bank financial companies, or that could arise outside the financial services marketplace. Okay, so that first one, right, is risk to financial stability. So interest rate risk, big risk to financial stability. Okay, it would be nice to identify them. We might actually want to, you know, like do something about it once we identify it. 2, promote market discipline. Remember market discipline? They mean private market discipline. And by what? By eliminating expectations on the part of shareholders, creditors, ding, 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 ding. That means depositors, folks, and counterparties of such companies, that the United States government will shield them from losses in the event of failure. Wait a minute. Isn't that what we just did? The United States government, in the form of the FDIC, just used FDIC funds to ensure that creditors, in this case, uninsured depositors, were shielded from losses in the event of failure. So we're 0 for 2 in purposes. And 3, to respond to emerging threats to the stability of the United States financial system, which means we're 0 for 3 because FSOC in all of this report to Congress had 75 charts in this report in 2014 focusing on interest rate risk, and not a single one of them provided unrecognized losses due to interest rate risk, which would be the one chart you would need. And then to explain to Congress, and this can cause runs, and they can run into $40 billion a day. And they can take places with purported market caps of 15 billion and turn them into radioactive toast. And they can do that in 3 days, or actually 1 day. But we didn't do any of that. There is only a joint federal regulatory advisory on interest rate risk. Definitionally, that means it is not enforceable. I used to be litigation director of the Federal Regulatory Agency, an enforcement director in the West region and such. And that means when you, quote unquote, you can't violate an advisory because it's just an advisory. So I can't take action against you. I can't even get admitted into court, the advisory, because that's all it is, advisory. And by the way, the Supreme Court's about to make all of this much worse by gutting our ability to issue enforceable rules. But this advisory, on top of that, even if it was a rule, is useless. It doesn't say there's no positive value in taking substantial interest rate risk. It doesn't say, you know, there are grave downsides. It doesn't say, so you can't do it. And you must report whenever you have failed, screwed up. and have very substantial interest rate risk. And I don't mean a report at the end of the month. I mean, you must pick up the phone that moment and alert us so that we can take emergency action. And so this bill stuff that was done under the Trump administration, yes, it was a bad bill. Yes, it was a con. It was really done for massive banks like SVB, which expressly was one of the leaders in the process and was in the hundreds of billions of dollars. And so they use this community bank stuff, you know, teeny tiny folks, and they use it to deregulate the massive banks. But these rules, A, weren't rules. They were advisories, and B, they didn't say anything particularly useful, and they didn't provide any grounds for taking useful action. But without those, as a regulator, you still could take action. I did this thousands of times. Not this specific, obviously, but risks, against these kinds of risks. But they're not doing that, right? There's no public indication that they took action against any of these places with massive interest rate risk or massive buildup of uninsured deposits. Mostly, though, there simply aren't any leaders that have a combination of brains and spines that would actually do this. So one of the things that the Dems are saying is, oh, there would have been stress tests, but for this legal change under Trump. Yeah, and here's the news. Stress tests, you know, the big stress tests you talk about, hear about, read about, they do not take into account runs. Which is why Fannie, Freddie, Bear, Lehman, the big three Icelandic banks, they all passed stress tests with flying colors. Fannie and Freddie, being good publicists, claimed that their stress tests were so severe it was the equivalent of, and I quote, nuclear winter, unquote. But none of them include runs. And Fannie and Freddie were blown apart within days, and all these others. And it's substantially the equivalent of runs in all of these cases. And large part, it's often due to interest rate changes, not always. Sometimes it's due to credit quality finally being realized as being no credit quality. The point is, we know that banks can fail extraordinarily quickly while having huge reported capital. It is the norm. That is the norm for these failures, not the exception. Okay, but again, this was an absolute clown show. If you can't get SVB right, you pretty much need to go home. We need new leadership in all of the top federal regulatory agencies. FSOC is probably useless, but if you want to save it, you have to put people who are actual regulators as opposed to conventional economists on, because what they do overwhelmingly is try to offer excuses for why we shouldn't regulate and why we can trust elite bankers. And this, again, is the lesson. You can't do any of those things. Okay, so should I go to Matt? Should I go to chat, or how do you want to do the responses?
Yes, if you go, actually I have some questions lined up for us. So if you stop sharing.
Yeah, there, that one's easy.
Okay, great.
Let me get, is it still showing on my screen?
Yes. Nope. We've got you there.
I was there. I must have hit something. Maybe escape. No, minimize. Oh,
got it. Great.
There's a way.
Thank you. Yeah. Well, thank you so much. Forgive me for saying so, because sometimes I leave your lectures not feeling so optimistic. You know? Okay.
Job opportunities for folks who are real economists.
There you go. First question is going to be from me. So, week and a half before SVB failed, one of the executives sold millions in bank shares. Some were paid bonuses on the Friday of the week that they failed. And then Signature Bank, which we didn't get to talk about, but they also failed last weekend, made some interesting loans, including to the family of our former president. Now, we certainly can't accuse anybody of wrongdoing or anything like that, but after taking your courses, especially on white collar crime, this raised some red flags for me. So is my detector off, or are there maybe some indicators of dishonest behavior there?
So there are definitely indications that people may have exploited their unique information to protect themselves and their cronies. And the federal government is leaked that, or actually, I guess, must have been released by the Justice Department in this context, that the FBI is investigating, at least at SVB. You're right, we had those, and we had also a Silvergate, and we have Republic on the ropes, and we have Credit Suisse in major problems. So I have not concentrated on the others simply as a matter of time.
Thank you. Our second question is from Raul. It says in 2020, in the waning days of the Trump administration, FDIC Chair Jelena McWilliams created a primary purpose exemption to the broker deposit rule, specifically to allow tech and fintech companies to place deposits in banks without following the typical rules. In light of what you've learned about Silicon Valley's approach to finance, are you concerned about this?
Yes, but more broadly, as I said, they have not understood the intersection of interest rate risk and uninsured, deliberately having large amounts of uninsured depositors. Their mindset comes entirely from conventional economists. And for a conventional economist, when they hear they're uninsured depositors, they think that's great. They think that's a source of private market discipline, and the world is going to get much better. I would also say that particular chair was notorious, even within the Trump administration, as a powerfully destructive, willfully destructive anti-regulator. And that's saying something.
Yes. This is from another viewer here. From an econ perspective, what ultimately determines whom wields more influence between the chairman of the Fed, the Federal Reserve, or the Secretary of the Treasury?
From an econ perspective, I'm not sure what that means, but in different spheres,
yes,
each of them could justly be positioned or described as the most powerful economic person in the world. All right. The Fed, obviously, we're talking about interest rates and money supply, but the Secretary of the Treasury essentially could run FSOC. It's an FSOC entity. It could run the comptroller of the currency. And on top of that, it does all kinds of finance in conjunction with the Fed. So all of these people could be a real force for good. And they tend to be a force again, this is my dead wrong. It isn't just that they're not producing the benefits, the extraordinary benefits they promise. It's that they actually make the world worse. And they make it not a little worse, but a lot worse.
Yes. Let's see. In light of that, I have a question from, it appears to be a student. What career paths to enter for the pursuit of effective banking regulations? Who are we going to replace those folks with?
Yeah, so it is a good time demographically to go into the federal government. I mean, I was litigation director of a federal agency with a docket of 10,000 cases when I was 33 years old. That doesn't happen in the private sector. So you can learn enormous amounts from the people around you. The problem again isn't that people are stupid. It's that for decades they've been broken, right? So the biggest single deficit is a deficit of courage that leads to a deficit of, they just don't even think about acting in an effective way. So you can learn an enormous amount. You can get much more responsibility than in the private sector in a quick time, and possibly you'll be in a position to influence policy in really important ways. We were in very unusual circumstances, but we really were able to change an immense number of things in the savings and loan debacle.
Yes.
You might end up in similar circumstances.
Great. Why would banks invest in HPM when the Fed essentially confirmed a raising interest rate? Is this not an obvious product of corruption at the highest level?
Okay, so again, never ask what banks, ask what bankers. So why would a banker do that? The banker would have done it because the yield would have been higher, pathetically higher, maybe in some cases, but it would be higher, and his bonus would go up. Now that, as I just stated it, is not enough for a crime, which is to say, there are lots of things that are predatory, strategic behavior. And if you're smart and can limit yourself, your greed, there are big sweet spots. Sometimes they spiral out of control. And even if they started out just being predators, they become criminals. To be clear, the predators can be every bit as harmful as the criminals. And of course, they can do both.
This is a question that piggybacks off of that. Moody's downgraded the entire banking industry for this interest rate risk. If all CEOs are crooked or there are no whistleblowers who are fired from their credit risk jobs, how can we find credit risk managers who will do their jobs correctly? Should they work on fixed term contracts? Should they have a PhD in hard STEM fields, or is a finance background okay? So what kinds of people do we want to?
That's really good stuff. First, risk officers are too quant oriented, right? You need quant plus, and you know it's self-serving, but there's one by a top quant at Enron that says, you know, I wish I read that book that you held up. I didn't understand how these frauds worked, and I really could have been much more effective. So that's one thing. Second thing is actually learn the business, right? So it's one thing to study the math, and yes, at top level quants, they're going to almost always start with at least a master's in either mathematics or in physics. The math skills of folks in those compared to the math skills of somebody in an econ PhD program are typically dramatically superior. Okay, so if you really want to do it, you want to get a math or physics master's at least, and go do it. Yes, you should then get them to immediately understand the business and understand how people can game it, block it. Now, I would simply recommend to the person, read the report of the Inevitable National Commission to Study the Causes of the Great Financial Crisis. It has about 25 pages on chief risk officers. And basically the story was either they became ineffective deliberately to keep their job, or they were fired or deliberately excluded from the room by the CEO. So the questioner is quite sophisticated in understanding that we need to change the institutional and the pay arrangements. It has to be more like an ombudsman, and to report not just to the CEO, but to external folks. But then again, there's no real proprietary secrets that should be safeguarded as to what your interest rate is. You can safeguard your model, your proprietary model, but the bottom line, that shouldn't be proprietary. That should be disclosed.
Yeah.
And if you fire the person, what we ought to do, if they turn out to be right, is have a clawback in which you take the CEO, all the CEO's bonuses, and give it to the guy or gal that got it right. I just made that one up on the spot, but it sounds good to me.
So yeah, seems fair to me. Let's see. Has the Fed overstepped their boundaries by engaging in fiscal policy and monetary policy, and have banks overstepped their boundaries by engaging in fiscal policy like Barney Frank's connections? It seems like monetary policy and fiscal policy are only separate in nominal terms. In reality, both sectors appear to operate from both capacities.
Well, they should, of course, be integrated. Has always been one of the problems with Fed independence. In a logical world, you would want a decision maker who would do both. Now, so the Fed sells this on the basis of you can't trust any Secretary of the Treasury. And it's not that there's no truth to that. There are many countries where that's a problem, but the independence causes a problem as well, right? When you have a Fed chair say, I want to cause a recession, and I will not be happy till I cause a recession in which millions of people lose their jobs, then I think he, in this case, has massively overstepped. But I also think he's just a bad economist when he says something like that.
What do you think are the implications to FDIC limits? There is talk that this opens up some additional things as president. Are you as pessimistic as I am about banking regulatory landscape changing at all?
I don't know how pessimistic you are, but you are certainly read me correctly, as you said, Matt, right at the beginning, that I don't cheer people up very often when I do these things. But tell me again the first part of the question.
What are the implications for the
limit, the change? Yes. Okay, so from a conventional economist standpoint, they hate the $250,000 limit because it's the highest in the world, and typically much higher than elsewhere in the world. So they think it maximizes moral hazard, gambling for resurrection, all those types of things. I don't think that's true. I think 250,000 is actually fairly sensible, given what people tend to leave in a bank who have, so that, this is sort of a worry for the upper middle class type of thing, right? And most of us don't have a problem with a $250,000 insurance limit. But I don't see any particular reason why I want to make the upper middle class wary about banking. Okay, so fine. So to me, it's not a particularly big deal. Now, if what the questioner is asking is the ability to say, oh, for you, for you, it's not a $250,000 limit, and you're someone who's going to stand to make billions, as a Silicon Valley investor, and you chose to put 70 million, say, in SVB, I don't have a moral case for why we would give you money. And if we do, I would say, if you make it big in your venture, pay it back plus a 50% return, right? We should be given an option in those circumstances if we're bailing out either rich or potentially rich people.
This is a similar question. What do you think are the implications of the Fed collateralizing assets at the purchase price versus the current market value? And what do you expect, how do you expect banker behavior to change because of that?
Okay, so first, let me make a statement that's collaterally related that I just came together for me in preparing this talk. The Fed has a freaking unbelievable amount of authorities. It has like 9 different authorities at least. It doesn't trust markets. It doesn't believe they can be trusted. And these are some of the thickest markets in the world. It's extraordinary. That should be super publicized, that the Fed doesn't believe in them. Now, it's a terrible thing to take it at 100 cents on the dollar. There's no need. You're encouraging people to take interest rate risk. If they don't have, if what you're saying is this place is deeply insolvent on a market value basis, and therefore it's not going to borrow from us, it shouldn't be in business. It shouldn't have been in business many, many, many months ago. So thank God it's finally going out of business. It's a good thing, not a bad thing.
I think this will be the final question. This is kind of piggybacking off of that. As too big to fail banks are getting bailed out and risks eliminated, there are in many ways not completely private institutions. Is there argument to be made about public banking or nationalization of investment banking?
I think nationalizing investment banking would probably be a terrible idea because it would become the greatest way to help the ultra wealthy you can imagine. But yes, public banking definitely should exist as an alternative, right? And I think that that we definitely would want to have something analogous to the postal banking that should have never been eliminated. We should have a plain vanilla banking system in which they're not ripping you off and all, trying to find ways to cross-sell constantly in all of those things. So yeah.
Gotcha. Thank you. Let me share this. So I want to thank Dr. Black for joining us. I want to thank Dr. Chernova and the OSUN EDI team, and especially the UMKC Econ Club and Economics Department. Please remember, this is part of a conversation. I think we got a very important part of that conversation this afternoon. If you were interested in staying in touch, staying informed, please read the New Economics Perspectives blog. Pick up, again, it's 20 years, almost 20 years old, but still so relevant. The best way to own a bank is to own one. Keep up with the LPE team at UMKC, and if you want to further your education in this, UMKC is probably the best place to do it. We have an interdisciplinary PhD program, one of the only in the country, where you can take classes in the law school with Dr. Black. Changes how you think about econ, certainly changes the way you think about the law. And keep in touch and stay up to date on OSUN Eddy events by following that Twitter link that we have there. So Dr. Black, thank you once again. Thank you so much. Dr. Chernova, thank you so much. And everybody have a happy St. Patrick's Day. I hope you all have your green on like I do. There we go.
Thank you indeed. Follow us for the link of the video. And sorry we couldn't get to everyone's questions, but stay tuned. I'm sure there will be more events on this topic. Thanks, Bill and Matt. Thank you so much for organizing this event.
Gotcha. Have a nice weekend, everybody.
Thank you, everyone.